Getting underway with reporters here on Capitol Hill.
Long-term budget outlook, showing what would happen to the budget over the next 25 years under a number of different fiscal policies. Today's report differs from the report we published last year by incorporating the effects of the significant tax legislation that Congress enacted in January, by including a wide range of recent data, and by having some significant methodological improvements. But the bottom line remains the same as it was last year. The federal budget is on a course that cannot be sustained indefinitely. In our extended baseline, which largely follows current law, we project that federal debt held by the public would rise from 73% of GDP today, already high by historical standards, to 100% of GDP 25 years from now, even before incorporating the harmful economic effects of the rising debt. To be sure, the deficit has shrunk dramatically during the past few years, from nearly 10% of GDP in 2009 to about 4% this year. And we expect that under current law, the deficit would decline further to about 2% of GDP. After that respite, however, we project the deficits would start growing again. Federal spending would be pushed up by rising interest payments on the federal debt and by growing costs for Social Security and the major health care programs, Medicare, Medicaid, and subsidies to be provided through insurance exchanges. Interest payments on the debt would rise as interest rates rebounded from their current unusually low levels. In particular, with debt so large, the increase in interest rates that we and others expect would have a very large effect on interest payments. Projected spending for Social Security increases relative to GDP in our extended baseline because of the retirement of the baby boom generation, which would increase the number of people eligible for the program by more than 1/3 in just 10 years. Spending for the major health care programs would increase for 3 reasons. First, the retirement of the baby boomers. Second, rising costs of health care per person. And third, the expansion of federal support for health insurance for low-income people. Meanwhile, projected federal spending for all other programs taken together declines sharply relative to GDP in our extended baseline. Such spending has averaged roughly 11% of GDP during the past 40 years. It is currently about 10% of GDP, a little below its average, and would fall to about 7.5% of GDP in 2023 and 7% in 2038. By 2020, under current law, total federal spending, apart from Social Security, the major health care programs, and interest on the debt, would be a smaller percentage of GDP than at any time since the 1930s. Thus, the upward pressure on federal spending relative to the size of the economy comes not from a general growth in the size of the government, but from growth in just a handful of the largest programs, Social Security, Medicare, and Medicaid, along with the rising costs of servicing the government's debt. Federal revenues would also increase over time under current law, but more gradually than federal spending. Federal revenues have averaged 17.5% of GDP during the past 40 years. They're now a little lower, but rise to 18.5% by 2023 and nearly 20% by 2038 in our extended baseline. The gap between federal spending and revenues would widen steadily after 2015. By 2038, under our extended baseline, the deficit would be 6.5% of GDP, and federal debt held by the public would be 100% of GDP, even before we account for the economic effects of that increase in debt. That would be more than any year except 1945 and 1946. With such large deficits, federal debt would be growing relative to GDP, a path that could not be followed indefinitely. In our report, we separately project how the economic consequences of the policies that underlie the extended baseline would affect the long-term budget outlook. The growth in debt would reduce the nation's output and raise interest rates relative to what would happen if the debt were more stable. That in turn would lead to wider budget deficits. With those effects included, debt under the extended baseline would rise to 108% of GDP in 2038. Debt that is so large relative to our annual output would, in the long term, reduce output and income, compared to what they would be if debt were closer to its historical average percentage of GDP. Debt that is so large would also require higher interest payments, reduce lawmakers' ability to use fiscal policy to respond to unexpected developments, and increase the risk of a fiscal crisis. In our report this morning, we also show the effects of some alternative sets of fiscal policies, some that would produce a larger deficit than under current law, and some that would produce smaller deficits. For example, if certain tax and spending policies that might be difficult to maintain for a long time were modified, what we call the alternative fiscal scenario, federal debt would be much greater than 108% of GDP by 2038. In addition, we devote a chapter of the report to the uncertainty of long-term budget projections. We discuss a number of sources of uncertainty and present budget projections based on different outcomes for productivity, interest rates, and federal spending for health care. Of course, any projections this far into the future are very uncertain. Nevertheless, our analysis shows that under a wide range of possible assumptions about some key factors, the budget is on an unsustainable path. As lawmakers consider changes in policies that would put the budget on a more sustainable path, they will face choices about the magnitude of deficit reduction, the policies to be used to reduce deficits, and the timing of deficit reduction. Economic theory does not say what the optimal amount of federal debt is, nor what the right amounts of federal spending and revenues are. But a significant reduction in debt from its current percentage of GDP would require substantial changes in tax policy, spending policies, or both. As an illustration, if lawmakers wanted to bring debt down to 31% of GDP in 2038, a little below its 40-year average, using policies that phased in over the next decade, they would need to enact a combination of increases in revenues and cuts in spending that would total about $4 trillion during the decade. In deciding how quickly to reduce deficits, lawmakers face difficult trade-offs. Waiting to cut federal spending or taxes would lead to a greater accumulation of debt and would increase the size of the policy adjustments needed to achieve any chosen debt target. However, implementing spending cuts or tax increases quickly would weaken the economic expansion and give people little time to plan for and adjust to the policy changes. The negative short-term effects of deficit reduction on output and employment would be especially large now because output is so far below its potential or maximum sustainable level that the Federal Reserve is keeping short-term interest rates near zero and could not lower them further to offset the impact of changes in spending and tax policies. Thank you. My colleagues and I would be happy to try to answer your questions. Yes, sir.
Your alternative fiscal scenario puts with the economic feedback, puts the debt at 190% of GDP in 2038. Many of us have found that the alternative fiscal scenarios often seems to be the most plausible in my comment, but maybe I'm wrong. What are the key factors that go into that very different projection in the assumption?
So the extended alternative fiscal scenario differs from the extended baseline on both the spending and revenue sides. On the spending side, that scenario takes away the sequestration and a reduction in discretionary spending caps. It goes back to the original spending caps established under the Budget Control Act. It also takes this broad other category of federal spending that I noted would be so low under current law relative to its historical relationship to GDP and pushes that back up toward a more standard relationship to GDP. That's on the spending side. On the revenue side, this alternative scenario keeps federal revenues around 18% of GDP, again closer to their historical average, rather than allowing them to rise toward nearly 20% of GDP, as we think they would do under current law. So this scenario can be viewed as taking a set of policies that might be difficult to sustain, a set of policies that are in current law that might turn out to be difficult to sustain, and seeing what would happen if one, in fact, turned off those policies and reverted to a more standard historical experience. But I wouldn't say that it's a more plausible scenario in the sense that a debt of 190% of GDP would be quite extraordinary by the standards of this country or almost any other country. So I don't think you should view that as the realistic projection. It's meant to show what would happen under a different set of fiscal policies. And that set of changes turns out to matter a tremendous amount, particularly if one compounds them over 25 years. I think I should be asking people to say who they are and where they're from as we go along.
Senior Economics Congressman Barron's.
Thank you.
Rich Edson from Fox Business. But when you look at the other fiscal scenario, $4 trillion of deficit reduction over the next 10 years to arrive at 31% of GDP by 2038, do you factor in what increased taxes and reduced spending would mean for economic growth?
Yes, let me explain. We look at three alternative sets of fiscal policies in the report. One of them is this particular alternative fiscal scenario, which outlines a set of specific differences in tax and spending policies. The other two we look at are just reductions in deficits, ones that we looked at earlier in the year in terms of their effect within the 10-year budget window. And they're simply $2 trillion worth of reductions and $4 trillion worth of reductions in the 10-year window, but not specified in terms of whether they're on the spending side or the tax side or what the particular policy choices might be. So for the alternative fiscal scenario and for the extended baseline, when we look at the long-term effects on the economy, we take account in particular of the amount of federal debt and of marginal tax rates, the tax rate on additional dollars earned, which affect the incentive to work and to save. So for those particular policies where we have actual tax policies written down that we're following, we incorporate the effects of tax rate changes as well as the effects of changes in debt. For these two illustrative deficit reduction scenarios where we have not specified particular changes because we're not trying to lead the Congress in particular directions, we don't have tax rates to use in that sort of analysis. So the economic effects of those scenarios are based just on the different amounts of federal debt that would be held by the public.
So not really accounting for the $4 trillion fiscal drag because you don't know how that fiscal drag will be made up?
No, so we do account in the short term, the fact that deficits would be smaller under those policies would produce some drag on the economy. But in contrast with our analysis of other proposals in the past several years where we've had different sorts of responses to different specific policies, here we picked a sort of average response from a set of policies. And in the long run, we use our usual modeling to look at how rising debt crowds out investment and thus reduces output and income. Welcome.
We're going to take a really question. Excuse me. Could you discuss the role of healthcare spending on these long-term outlooks, how it has improved them, and what, if we know, would happen if we got rid of Obamacare?
A lot of questions in that. To start with, we show in the back of the report that federal healthcare spending in 25 years from now would be a little more than 0.5% of GDP lower in our current projections than it was a year ago. And that downward revision comes largely from the downward revision that we made to our projection of spending for Medicare and Medicaid within the first 10 years of the projection. So in the 10-year outlook that we released in the spring, we talked about having marked down our projections of Medicare and Medicaid spending a fair bit from a year ago. And in fact, over the past 3 years, we have reduced federal spending for Medicare and Medicaid in 2020 by about 15%. That's a response to the incoming data that we have seen in our analysis of it. For this longer-term report, the downward revision in the first decade matters a lot in terms of the cost of those programs as we project them even out 25 years. But additionally to the downward revision in the first 10 years, we've taken on board more data in terms of the slowdown in health costs. So our estimate of the underlying rate of growth of health spending, which comes from a historical average, is now a little lower than it was. So we have a lower level of healthcare spending to jump off from and a slightly lower rate of growth beyond that. And the combination of those factors is to reduce the federal health spending by about 0.6% of GDP in 2038, which is a significant difference. The Affordable Care Act did a number of things. We think of it in general in 3 large buckets. Partly it expanded insurance coverage, partly it reduced spending for Medicare, and then partly it raised revenues. Taking all those pieces together, we estimated that the Affordable Care Act would reduce budget deficits by a small amount and that repealing the Affordable Care Act now would increase deficits by a small amount. In these projections, we don't try to separate out all of those effects of the Affordable Care Act. The effects on revenues and Medicare in particular are now just, they're provisions of law that relate to other provisions of law, and that set of provisions leads to the projections that we have here. There's no natural way to separate out all of the Affordable Care Act provisions at this point. The one thing we do separate out in this report is the effect of the expansion of insurance coverage. And we have a table that shows a decomposition of the growth in federal spending for the major health care programs over the next 25 years. And for those who are here, this is in a box on page 25 of the report. And I say we decompose the growth in federal spending for the major health care programs over the next 25 years. And of the total growth in health care spending, as a share of GDP, the aging of the population accounts for 35%. The excess cost growth, meaning the fast growth of cost per person in these programs, accounts for 40%. And the remaining 26% is accounted for by the expansion of Medicaid and the creation of subsidies to be provided through insurance exchanges. So the insurance coverage provisions of the Affordable Care Act explain about 1/4 of the increase in federal health spending relative to GDP over the next 25 years. And I should mention that when we also note in the report, if one looks at where federal health spending is going, say at the end of this decade in 2023, about 3/5 of it will be going to people age 65 or over. About 1/5 will be going to people who are blind or disabled under age 65. And another 1/5 will be going to able-bodied people under the age of 65. So even with the significant expansion of federal support for health care for lower-income people through both the expansion of Medicaid and the subsidies through insurance exchanges, nonetheless, the great majority of federal health care spending and the great majority of growth in federal health care spending is not related to the Affordable Care Act.
And related to that,
and you are?
Oh, Jackie Collins on New York Times. Do your latest numbers account for the significant number of states, some with significant populations, that have rejected the expansion of Medicaid?
So in our projections from last winter, the ones that went into the 10-year forecast, 10-year projections that we released in the spring, we estimated that about 45% of people who would have been eligible for the Medicaid expansion if that had taken effect in every state would in fact be eligible for the Medicaid expansion. So again, of the total number of people who could have gone into Medicaid through this expansion, if it occurred in every state, we expected that 45% would live in states where they actually could go ahead and where this expansion would occur. So far, about 20 to 25 states and the District of Columbia are expanding their Medicaid programs. The remaining states are still thinking about it or have decided against expanding. Those 20 to 25 states and D.C. account for about 35 to 42%, I'm told, of the people who would have been made eligible for Medicaid if all states had expanded coverage. So that figure looks to be running a little below what we had anticipated. Our projection, as you may recall, had a gradual expansion of Medicaid eligibility and enrollment and a gradual expansion of enrollment in the insurance exchanges. We expected from the beginning that it would take some time for all the systems to be put into place and for people to understand the systems and to sign up for these programs. So we have a gradual expansion, gradual increase in the number of people enrolled in Medicaid and a gradual expansion in the number of people receiving subsidies through insurance exchanges over the next few years in our projection. Now, of course, we'll do new projections again. And those spring projections, Jackie, are the ones that underlie the long-term projections here. So there's been no change in that. We'll do new projections, of course, early next year, and we'll take on board any information that, that we can get our hands on at that point. Jonathan.
Jonathan Nicholson with Bloomberg BNA. Two questions, totally unrelated, unfortunately. I know this is a long term, but you mentioned deficit for this year is expected to be about 4%. Can you give us any additional color on that? And also, in the extended alternative baseline, does that still include those elements of not paying for an SGR, and tax extenders that had previously been in the extended baseline, if I recall correctly.
Yeah, so on your first question, we projected in May that the budget deficit this year would be $642 billion. Our latest sense is the tax revenues will be a little less than we had expected. Federal outlays will probably be close to what we expected. So we think the deficit will be a little larger than $642 billion, probably still under $700 billion, still about 4% of GDP. And of course, we're not sure yet. There are tax receipts coming in this week, and other things will happen between now and the end of the month. But that's our sense as of the moment. And your second question is the extended alternative fiscal scenario. And yes, I mentioned earlier some of the key provisions that matter the most for those numbers, but the scenario also includes the replacement of the sustainable growth rate mechanism, which is how Medicare pays doctors, by a freeze on payments to doctors, and incorporates the extension of some provisions that are scheduled to expire, such as the higher depreciation allowances for businesses that are scheduled to expire at the end of this year. But as I said before, I think the biggest differences in the overall magnitude comes from the turning off these enforcement mechanisms from the Budget Control Act, from pushing back up this other category of federal spending to closer to a historical norm, and from holding tax revenue around 18% of GDP indefinitely, rather than letting tax revenue rise relative to GDP through, primarily, when it occurs under current law, through a sort of real inflation-adjusted bracket creep, where tax brackets are indexed for inflation, but not for real income growth. And we think there will be real income growth that will move people slowly into higher tax brackets. And we talk in our report at some length about try to quantify the effects of this real bracket creep on the marginal tax rates, which affect incentives to work and to save, and on average tax rates, which show the burden of taxes on people, sort of taxes they pay as a share of their incomes. And we note that the tax system by 2038 would be quite different in its impact on people from the tax system we have today under current law, because of the way that law will interact with changes in the economy over time.
Jim Ryan with Bloomberg. Just to clarify, you're saying that the SGR you're assuming the SGR would be frozen, or that's
in the alternative fiscal scenario. So the extended baseline follows the concept of our 10-year baseline, and the baseline basically follows current law. So under current law, Medicare's payments to doctors will be cut by about 25% at the beginning of next year. And that is incorporated in our 10-year baseline from May and incorporated in the extended baseline projections we have here. But the alternative scenario is designed to capture what would happen if some policies that might be hard to sustain were in fact turned off. And we're showing the consequences of that for budget outcomes and for economic outcomes.
Yes. Keith from NPR, and this is probably asking you to do apples and oranges math, but there was this reduction in the growth of healthcare costs that subtracted from our long-term deficit and debt problems. But then there was this tax law change that was locked into place. How do those compare to each other in terms of the effect on the long-term outcome?
So the change in the tax law has a larger effect down the road than our revision to healthcare spending. Relative to last year's extended baseline, the debt we project this year is a great deal larger. Last year we thought that under the current law as it stood then, debt would actually come down from its current roughly 70% of GDP to close to 50% of GDP over 25 years. This year we think debt will go from its current 70% of GDP up to 100% of GDP over 25 years. And most of that increase comes from the change. I mean, I think the primary factor is the change in the tax receipts because of the change in law. The one piece in the other direction, piece of good news, was our downward revision to health spending. And
that's like a tiny thing compared to the...
Well, I don't want to, as I say, I think it's about 0.6% of GDP in 2038. That's a big deal, but it's not as big a deal as the change in tax law. And remember, the change in tax law extended lower tax rates for everyone except the highest income people. And it raised the thresholds for the alternative minimum tax and indexed them for inflation. So previously under current law, a thing that Congress had kept not letting happen, but under current law as it stood a year ago, many, many more Americans would have been paying some alternative minimum tax right away and then indefinitely in the future. And the Congress basically fixed that problem in the sense of, as I said, raising the threshold and indexing them for inflation. So now, as we show in the report, the number of people affected by alternative minimum tax and the revenue collected from it rises, but not very much, over the 25 years. So those changes were really very large in the 10-year budget window, but had even larger effects beyond the 10-year budget window. Another thing I should emphasize that you see in this climb of debt as a share of GDP, when there's a gap between spending and revenues, when we have these deficits, that adds to the debt. Then the next year, interest payments on the debt are higher, and that adds more to the debt. So these things can snowball, and you see this in our projection of interest payments, which are a little over 1% of GDP today. We think will be 5% of GDP by 2038. Now, a big part of that increase comes over the next half dozen years as interest rates return to more normal levels. But then beyond that, as debt rises, the interest servicing cost rises as well.
So, when we embarked upon deficit reduction, everybody talked about $4 trillion in savings. But what this report is showing is that whatever we've done, we've still got $2 trillion to do to stabilize our debt?
So there is certainly more work to do to stabilize the debt. I gave a talk last week on their slides on our website that show a projection of debt that CBO made in 2007, projection it made in early 2011, and the projection we made early this year. These were just 10-year projections. So in 2007, debt was 35% of GDP or so, and we thought it would actually decline slightly. We then hit a financial crisis and an economic downturn, the likes of which we had not seen since the Great Depression. And policymakers were those developments would automatically have pushed down revenues and pushed up federal spending in a way that would have led to much larger deficits and much more debt. On top of that, policymakers took deliberate actions to try to help households, support state and local governments, stabilize the financial system and the economy, and those policies had costs. So by early 2011, our projection was not for debt at 35% of GDP and heading down, it was for debt at 60 or 70% of GDP and heading up. Relative to the 2011 projection, our 2013 projection is a little lower. And in this talk last week, I break down the pieces of that. Part of that is health cost changes in our projections. Part of that is policy changes. But still, we are at a very high level of debt relative to GDP, given our historical experience and the experience of most countries. So under current law, as our extended baseline shows today, debt will rise as a share of GDP. One of our illustrative scenarios here was this $2 trillion of deficit reduction phased in over the coming decade. And under that policy, debt in 2038, for 10 years, there's the $2 trillion of deficit reduction. And then we set the amount of deficit reduction outside the 10-year window at the same percentage of GDP that it reaches in 2023. That's an arbitrary decision. We're just trying to give a sense of orders of magnitude for the Congress. But that policy then leads to debt in 2038 that is a little below the current share of GDP, but close to the current share of GDP. As it turned out, this $4 trillion policy, and these were numbers we picked back in the spring as nice round numbers. We're not trying to suggest there's a particular target Congress ought to have, because it's a matter of judgment. But as it turns out, that $4 trillion policy in the first decade pushes debt by 2038 down to just a little below its historical average of 38%, a little below its mark in 2007 of 35%. So the $2 trillion of deficit reduction over the decade, if then sustained after that, would keep debt close to its current high share of GDP. $4 trillion of deficit reduction over the coming decade, continued after that, would push debt back down so that it would be, by 25 years from now, a little below its historical relationship to GDP. Those are still very large numbers. And we need to remember here that what the Congress and the President have done in the past few years is to raise taxes relative to an alternative scenario, but to cut them a great deal relative to what had been current law, and to cut back on discretionary spending and some of the benefit programs, but not to make fundamental changes in either Social Security, Medicare, or Medicaid, or fundamental changes to collect more tax revenue. And that's the basic choice. We have a set of programs that, given the surge of people who will be eligible for them over the next decade, and the rising cost of health care per person. That set of programs will be much more expensive in the future than it's been in the past. So we as a society have a fundamental choice of whether to cut back on those programs or to raise taxes to pay for them. And so far we've chosen to do very little of either. And as long as that's the case, I think CBO's projections will keep looking like this.
Hi, it's Dave Lauder with Reuters. Just a quick another question about interest rates. You mentioned the returning to normal of rates. What does that look like under this scenario? What kind of percentages are we talking about? And then also, after the Fed announced its signal its tapering program, rates did spike up quite a bit, higher, I think, than most of the market had anticipated. Has that changed your view on rates and the way you look at them in the future?
So when last I checked, the interest rate in the 10-year Treasury note was about 80 basis points above what we had projected it would be during the third quarter. So that's a substantial difference. But we had been projecting the 10-year Treasury note rates would rise quite a bit over the next several years. So we view this as simply an acceleration, a pulling into the present of something we thought was going to happen within a few years anyway. So if we were to do new baseline budget projections today, we would project higher interest costs in the next few years. But in our 10-year projections from the spring and underlying the projections here, we had rates coming up a lot anyway. So I don't think that what's happened the last few months would change our projection of interest rates 5 years from now, 10 years from now, 25 years from now. And in fact, the market read on interest rates 5, 10 years from now is not much different than it was earlier in the year. So I think what we've just seen, again, is an increase in rates that has come sooner than we expected, but not something that would change the fundamental contours of our economic forecast. But it's certainly true that as rates rise from their level very close to zero to something closer to their historical average, that increase in rates applied to debt that is 70% of GDP has a huge effect on the government's interest payments. And I think those interest payments reach about 3% of GDP by the end of the decade, and they say 5% of GDP by 2038. Does that answer your question?
What you're saying is that it will even out, sort of over this long-term window.
Again, I think if you picture a projection of interest rates that had a pretty steep upward slope and then leveling off, we've started up sooner than we thought, and that would raise projected interest costs in the next few years. But since we were expecting a very large increase anyway a few years from now, this increase early doesn't change the path further down the road.
Right, but if you get in a situation where the deficits are bigger, say under your alternative fiscal scenario, that does then have an effect on the rate itself, which then has an effect on the deficit, which has an effect on the rate.
Yeah. So in our Chapter 6 of the report, where we look at the economic effects of different paths for fiscal policy, we look at the economic effects of the alternative fiscal scenario relative to the extended baseline, and we show that we think interest rates would be noticeably higher. But we also note that we don't have a great confidence in calibrating that increase, because when we, as in this report and other places, project the effects of debt on interest rates, we're drawing from historical experience in which U.S. Treasury debt has risen and fallen relative to GDP, but it's not just headed off indefinitely in some direction. And we say in here that if debt looked like it were on a permanently upward trajectory, that might well induce some reaction by financial market participants that would be out of line with what we've seen given the historical sorts of variation in debt to GDP. We just don't think we have a great analytic basis for quantifying that effect. So the quantification that we have relies on our sort of standard models and the traditional sorts of relationships between interest rates and debt and GDP. And even then, interest rates are higher, and that matters for the debt dynamics, as you say. But I just want to caution that we think we have, and have tried to say that we have, greater uncertainty about projecting the effects of paths of fiscal policy that are outside of our historical experience.
Of course, the path you just mentioned could only cut in one direction, I assume. It's not going to mean lower interest rates, but only mean...
I think the extra risks in that case are on the high side.
Only on the high side. I assume your studies always have on your website supplemental tables on many of these questions we're asking, so probably we'll get the answers if we really look at it and then want to focus on it.
Yeah, so there's an extensive set of extra data that went up on the website 10 o'clock this morning, and hopefully that will help you.
My question having to do with the whole evolution of the downward adjustment in the increase in per capita medical health care costs, that's just the way it's specified. Could you give me a couple of numbers on how, to what extent it's been downward revised, but then also address a concern of mine, which may be unjustified. It appears that there's still a danger that the slowdown in healthcare costs is really cyclical and not secular. That it appears as though it's mostly cut in, coinciding with the Great Recession. You're still having a low employment population ratio, a high unemployment rate, and so there's always a danger that one would imagine a priori that you get what I'm going. So what's your comment?
So in revising our health spending projections in the past few years, we've drawn on our own analysis of the data we've seen and on the analysis of outside experts. A number of outside experts who looked at the causes of the slowdown in national healthcare spending have attributed part of that slowdown to the financial crisis and recession and how the ways in which the loss of wealth and income presumably have affected demand for healthcare. And they've attributed part of the slowdown to non-cyclical factors, to structural factors. Two of my colleagues did incredibly thorough examination of the slowdown in Medicare spending. We published this working paper in August. In that paper, they tried very hard, but were unable to link the slowdown in Medicare spending growth to the business cycle conditions, to the loss of wealth. And they tried to do this not just by looking at the time series data, which in fact don't show historically a correlation between Medicare spending growth and overall economic conditions. But I think much more persuasively, they looked at microeconomic data, households that had suffered larger wealth losses or experienced other bad effects of the economic conditions, and those households did not seem to have any different reaction in their Medicare spending. That leaves open the very important question of, well, if it's not the financial crisis and recession, what is it? And of course, this is an uncertain business, and my colleagues went through and tried to quantify a number of other effects, changes in the age and health status of Medicare beneficiaries, changes in the payment rates that Medicare makes, change in the use of prescription drugs, changes in whether people are enrolled in both Part A and Part B of Medicare, or just in Part A, a whole set of factors that they were able to quantify, but the whole set of quantified factors didn't explain very much of the slowdown. There's another part of the paper that goes through a number of possible factors that were very difficult to quantify, and they tried to pull together the scraps of evidence and to see what stories might have been more or less important. But it doesn't lead to a clean, sharp, well, here's the effect, and now we know how persistent it will be. So when we do our projections, we're trying to make projections that are in the middle of the distribution of possible outcomes. We want there to be, in general, equal chances that we are too high and that we are too low. I think that's the best information we can give to Congress. So as we've seen this very slow growth in Medicare and Medicaid over the past few years, and slower growth in premiums in the private insurance market than we had expected earlier, we've tried to construct projections for the future that balance risks. So I think there are a set of reasons why we might take the recent experience very seriously, give it a lot of weight in our projections. One of those is just the breadth of the slowdown. So as I said, it's in Medicare and Medicaid and the private health market, health insurance market. Within Medicare, it is in Part A and Part B and Part D. My colleagues show that it applies across regions. It applies across beneficiaries with high and low health costs. So it's just a very widespread phenomenon. So that suggests it's not just a few idiosyncratic factors. I think that's one reason to give a lot of weight to the recent experience in making our projections. I think a second reason is that the slowdown's been going on for some time. It is not really a matter of 2 years or 3 years. It's half a dozen years or longer. It's another reason to give a lot of weight. I think a third reason to give substantial weight to the recent experience, for Medicare at least, is that we have not been able to link the Medicare slowdown to the macroeconomic conditions. Now, on the other hand, I think there are 3 reasons, as it turns out. Didn't start that as an objective, but we did end up with lists of 3. 3 reasons to put limited weight, or more limited weight in the last few years. One of those is that health cost growth, health spending growth, has varied a lot in the past. And previous periods of slower spending growth have been followed by a pickup in growth again. And in some of those previous periods, some of the stories one heard, some of the anecdotes that were told, sound like some of the stories and anecdotes one hears today. So I think we can't rule out that possibility. I think a second reason to put only limited weight on the past several years is that there continues to be technological development in the healthcare business. I'm actually discussing a paper at the Brookings Institution on Thursday that looks at the healthcare cost slowdown, and I think the paper is embargoed, but I will say they talk about a number of areas where the practice of healthcare is continuing to push in new and expensive directions. So we may have seen a lull in some of that, but that doesn't mean that it won't recur. I think a third reason to put less weight on the last several years, for Medicare again only, is that Medicare remains primarily a fee-for-service system in which the incentives for providing more care are still there. So I think there are some good reasons to put substantial weight on what we've seen in the past several years, but reasons to be cautious in how much weight to put on it. And what we have done in response to that is to have projections that maintain slow growth of Medicare and Medicaid spending for several years, but the number of years from now, growth rates come back up in our projection. And the level of spending in Medicare and Medicaid remains, in our projection, just permanently below what we had said a few years ago. But we don't have a widening wedge, a very rapidly widening wedge in the long term.
Have you provided some kind of graph which shows like what we were projecting as of 06 versus today? Or could you just tell me what's been the magnitude of downward revision? Is it like down by a third or what?
Well, so we've provided pieces of this. It's not easy to actually pull this all together because our projections get revised for lots of reasons. We change economic forecast, legislation is enacted. So it's complicated to do these historical comparisons. But we have said a number of places that for 2020, our projection of Medicare spending growth is now about 15% below where it was in the spring of 2010. And for 2020, the level of Medicare spending, 15% below. And in 2020, our projection of Medicaid spending is about 15% below where it was a few years ago. And that is a bigger difference than we've seen so far. I should say in 2012, Medicare and Medicaid spending reached about 5% below what we'd expected in 2010. So we have seen some of the slowdown, and we are projecting more of it to continue. But as I said, the gap between our earlier projections and our current ones don't get that much wider later on, a little bit wider, because we have taken some of this recent news into our projection of the underlying rate of health cost growth, which matters for these long-term projections. And there's a chart in the back of today's report that looks at last year's and this year's projections of health spending growth. And you can see that this year's is lower, and most of that difference comes just in the next few years. Beyond that point, the lines are close to parallel, but not quite. The current line is a little lower slope than the line from a few years ago.
You're also expecting to put out a budget options selection at some point. Can you give us a timeline on how quickly that will be put into effect? And also, in this report, you talked about the possibility of a fiscal crisis brought on by the increase in debt growth. And I'm just wondering, what is your assessment of the rollover risk that Treasury may have as it tries to refinance its debt in the current debt ceiling impasse?
So on your first question, we plan to produce a volume of budget options this fall. I'm not going to be more specific than that. It's really a daunting task for us. The last time we did a set of options for reducing the deficit, we had about 100 different options. That's essentially 100 estimates of different proposals and a lot of writing to go with it. So that work is well underway, but I don't know when we'll be done, in particular because I don't know what Congress will need from us between now and when we could finish the report. As far as rollover risk, what we mean by a fiscal crisis is a point at which investors lose confidence in the government's ability to manage its finances and thereby won't lend the government money at affordable interest rates. We've been very clear, though, that it surpasses our ability, and we think anyone's ability, to predict when such a point might be reached. The language from the report today is how long the nation could sustain such growth in federal debt, referring to our projections, is impossible to predict with any confidence. Every country that has had that sort of problem has differed in some way. And the United States is different from other countries in ways that can matter. So we just don't have enough experience, certainly in this country, or even experience in other countries for which we can untangle all the different factors to produce some estimate of how much debt the country could have before it encountered that sort of problem. And presumably, the answer would depend critically not just on some amount of debt, but on what people thought would happen to fiscal policy in the future. So it is not a matter of just today's borrowing, but expected future borrowing, and I think a matter of confidence in the government's ability to make policy decisions. So I don't think there is a number out there that is like the number, and I don't think anybody knows how to find it.
There's a market expectation or a market anticipation aspect to it, sounds like.
Yes. Yes, absolutely. Jackie.
Doug, for purposes of comparison with the $4 trillion alternative, pick your 10-year window, whether 2011 from the BCA, 2021, or 2013, 2023. But can you quantify exactly how much Congress and the White House have actually achieved in that window in deficit reduction?
So we've not done that. In the talk I gave last week, I highlighted the revisions to different categories of the budget, and for those categories, one can see they are categories where there has or has not been substantial legislative action, but we didn't try to work out the specific numbers.
Congressman Van Hollen has a statement out today where he uses the figure $2.5 trillion since the BCA.
We have just not tried to do that kind of precise calculation.
Is it in the ballpark? I know you wouldn't want to refute the ranking member of the Budget Committee, but...
Well, so I don't speak about other people's comments. If we had an estimate of that, I would happily share it with you, but I don't know of any estimate we've done of that sort.
So the $4 trillion is on top of that amount when you do this alternative, right?
Yes. Yes. I mean, as a general matter, we're not trying to keep track so much of where we've been as to give Congress a sense of where we are going under current law as a benchmark for them to consider changes. So whatever they've done in the past has been accompanied by a collection of good and bad news out of the world. But we are at a certain place now, and we have projections of where we think we will go in the future. And that's what our $2 trillion and $4 trillion and other sorts of numbers are based on. Yes?
Is there a reason that you haven't done that calculation, like that it's impossible to do, or not really?
Well, I think it's difficult to do. As I said, our projections get revised for a lot of different reasons. And so trying to go back over some period of years and disentangle all the pieces is a little challenging. Not impossible, I think. But again, our focus is not so much on the things they've done as where we think the budget will go under the laws that are currently in place. And whatever the goal was viewed to be 3 years ago, however much has been accomplished, what matters, I think, is the situation as it stands now, the outlook as it stands now, and what sort of deficit and debt objectives the Congress has.
Is this the economic feedback analysis? Is this a first for the CBO? I don't recall seeing this before.
No, so we've done this before. it's complicated to do. One thing I should note is that in our 10-year projections, the budget projections and economic projections are completely consistent with each other. So the economic projections are what we think would happen in the economy given the budget outlook, and the budget projections are what we think would happen given the economic outlook. That's not quite true in most of this document because it's a more challenging task over this longer horizon. So the basic budget projections in the first 5 chapters all hold the economy fixed. Income grows and so on over time, but it grows as it has tended to in the past. It doesn't incorporate the effects of the budget policy. So that's in the first several chapters here. Debt reaches 100% of GDP in 2038. Then we go on and we incorporate later the effects of these economic feedbacks, and that's under those projections with the economic feedback, debt reaches 108% of GDP. So that's the reason for that difference. But we've done that sort of extra analysis in the past.
Was that in 2012, long-term, the June 2012?
Yes, there was a version of that in the June report as well. Again, last year it was done separately from the basic budget projections because of the complexity of doing this at that longer horizon, and also the complexity of doing it when fiscal policy is on an unsustainable course, which creates special challenges in the economic analysis.
Lori? Outside the confines of this report, probably, but can you shed any light, and have you been asked by Congress to shed any light on this X date when the Treasury will run out of money to pay its bills, and when in fact they have to raise the federal debt limit?
Well, there's still a good deal of uncertainty about when the Treasury might run out of cash, including, for example, how large the tax receipts will be this week. As you know, the Treasury said that it expected to reach its borrowing limit in mid-October and to have about $50 billion in cash on hand at the time. That projection seems plausible to us. And given the likely cash flows after that date, we think that the Treasury will probably run out of cash sometime between the end of October and mid-November without some change in the borrowing limit. We will be releasing a short report next week that will provide our latest view at that time, including, I hope, information we can glean this week. But the date on which the Treasury will run out of money is likely to be uncertain even at the very end because federal cash flows bounce around from day to day.
So what happens end of October to mid-November is that's when you say run out of cash, you mean start to not be able to pay its obligations.
Yes. Yes, we think that without some increase in the debt limit, the Treasury would be unable to meet its obligations sometime between the end of October and mid-November. Well, that's a good note to end on. No.
How would we know that this happened?
Well,
would we be dependent on them telling us?
Well, so I should emphasize that we aren't engaged in the day-to-day cash management of the government the way the Treasury Department is. We watch what's happening to federal spending and revenues, but the precise mechanics, the tools they would have under those circumstances, we just don't know. So the projection I offered was based on the set of extraordinary, quote, extraordinary measures that have now become fairly common. What else Treasury might do, I don't know. So, for example, the ability of the Treasury to delay making certain payments but not others is just not something that we can speak to.
And that projection also assumes they have no rollover problems with their options.
Well, if they have rollover, I have to think about that more carefully. I mean, the projection, if they can't sell, if they end up not selling as much debt on one occasion, on one date, then maybe they could sell more on some other date. I don't know how to think about your question, I'm afraid. What we're trying to do here is to offer a sense of under the regular workings of the Treasury's cash management, the point at which we think that they would not have as much cash as they would need to make the payments they would normally make on that date. And again, what else might happen or what else they might do, I think is other people's jobs in this town. Okay, so why don't we stop there? Thank you all very much for coming. If you have further questions, then we're happy to try to answer them. Thank you very much.
Thank you.
Congressional Budget Office Director Doug Elmendorf answering questions on the latest of long-term budget outlook by the CBO. And by the way, we have linked to that report on our website at cspan.org. The U.S. House is gaveling in next for